Hello, fellow investors. HPQ surged after reporting earnings last May 31 after hours. Was it really a good earnings report? This is HPQ's earnings snapshot. Revenues are up 3.86% from $15.877 billion last year, same quarter, to $16.49 billion. That's an increase of $613 million in revenues. COGS increased from 12.437 billion to 13.157 billion. $720 million increase in COGS. If we divide this by their respective revenues to get the COGS margins, it increased from 78.33% to 79.79%. Let's do the same with OE, or operating expenses. This weird shapes here, just add these three. OE decreased from 2.029 billion to 1.941 billion. A decrease in operating expenses of $88 million. OE margins decreased from 12.78% to 11.77%. Now, you might wonder, why do I do this? I want to understand their costs as well, because again, an increase in spending lowers the profit margins and the free cash flow margins, in which we are paying for in a stock. Now, let's do net income. Net income decreased from 1.228 billion to 1 billion. A $228 million decrease in income. Net income decreased 18.57%. Margin-wise, from 7.73% down to 6.06%. Why did it decrease? Because there was an increase in spending, particularly with the COGS. EPS decreased as well from 0.98 last year, same quarter, to now 0.94. Free cash flow decreased from 1.325 to 0.33 billion, 330 million. A decrease of almost 1 billion, 995 million. A decrease of 75.09%. Margin-wise, 8.35% down to 2%. So guys, if you ask me, it's pretty clear that HPQ's earnings were terrible, except for the revenues. Why did the stock surge then? Two things. One, when retail investors and some quarterly investors see this, they automatically buy into the stock because they beat earnings expectations. At least if you look here and what they hear from the news. If it goes up from here, of course they love it. But when it drops, they ask questions. This is the answer. Terrible earnings. Now, two, the people on the TV says it's because of the outlook, but nothing is certain in the future. These are merely projections, so I don't buy it for the outlook. Now, if you're looking to buy HPQ, this is their valuation summary. It's trading at fair values, at least by these metrics. I increased my PE assumptions from 456 to 567 after reassessing. Not by much that it would change everything though. I have fair values for HPQ of $38.47. Intrinsic value of $51.7. This is from Guru Focus. Warren Buffett's average price is $36.3. I have a high entry price of $38.92, but I'm conscious about my dividends. 3% dividend yield is $33.33. Again guys, I'm not buying HPQ until this gap closes, but there are deep buyers at 3% dividend yield at $33. I'm a bit skeptical about this intrinsic value of Guru Focus because their total equity is at deficit, 1.898 billion deficit, meaning liabilities are a lot higher than their assets. So I think there's some error here. Strong cash position this quarter, from 3.394 billion last quarter to now 4.477 billion. Current ratio is still below 1, not good. Share buyback is pretty aggressive, 600 million shares in 5 years. Price to free cash flow is very attractive, 7.89 only. I could be in it for a trade. I think dividends are safe with HPQ, only 18% payout ratio. All good for HPQ, just a little overpriced to me. If you didn't get these numbers and assumptions and you wanted to know what these numbers represent, how I came about these numbers, I suggest you watch my previous videos. You'll easily understand them, but I'll explain it very quickly just in case you're new to the channel. First metric, we want an EPS multiple lower than 3. It's 1.29. I use this metric when I'm screening multiple stocks. If it's above 3, I consider them overvalued, unless I look into them individually, because it might be that the EPS is just too low or the PE is just too high. I have to check for the anomalies. Second metric, we want to pay $1 or less for 1% of the money they're making, meaning we want to pay 1 PE or less for 1% of their profit or free cash flow margins. Their margins play around 6 to 10%. I use the usual 30% margin of safety here. Third metric, we want to pay a PE lower than the price to free cash flow, like it is now, 0.91, a discount. Fourth metric is basically the free cash flow margin once the dividends are discounted. You might want to buy stocks below their discounted margins. This metric can also tell you something about their future prospect regarding share buyback, dividend increment, and debt issuance. Fifth metric is historical PEs. We want to buy at a lower PEs compared before. That's basically it. Again, HPQ is trading at fair values. If you want to buy HPQ at fair values, go ahead. But I don't recommend buying at fair values. I want my margin of safety discounted as well. Also, I respect my dividend yields. So yeah, that's my take on HPQ. Put it on your watch list. Set some alarm at your entry price levels. $32. Maybe $30. Yeah, that's my entry price. See you guys next video.